This right here indicates that we have turned the corner. And now if it's going to go from the low end of that fair value gap, where is buy side? Where are the inefficiencies in terms of a premium? We have this high to that low. Right away, we have this inefficiency, we have this inefficiency, we have this inefficiency, and then the buy stops resting above here. And that's high probability draw on liquidity because watch, over here we have this. All of this is open. All of that right there is open. So once we start to trade higher, you want to look at how down closed candles should be supporting price advancing higher. We moved, bodies stayed within the context of that daily fair value gap. The market trades up, we have a down closed candle. Does the price come back down to it eventually? And does it support price going higher? Did it hit that level there and reverse or show willingness to act like a trampoline and rally higher? Yes. Now we have these two down closed candles here. This is one consecutive order block. Why is it an order block? Because we are in the lower half of the range between that high and that low. So if we trade above it and come back down into it, it should support just like a trampoline. If it trades down to it, does it support a move higher? And do we see price moving higher towards a higher inefficiency, which would be here, and or buy stops? There's a small little short-term minor buy side liquidity pull here because we have a candle high, higher high, lower high. So that's a swing high. So there's going to be trailed stop losses right there. And that's usually a big mistake, especially when it's coupled with an inefficiency just to the left of it. And then you have the buy stops that will be resting over here. The market capitalizes on the order block here, moves higher. We have a small little gap between this candle and that candle. So there's your fair value gap. Trades down into it there. Does it have a willingness to trade higher? Yes. Consolidation, down closed candle. It moves outside of the down closed candle. Does it trade back down into it? Yes. Does it act like trampoline, send price higher? Yes. So we bridged this inefficiency. We patched over basically all the sell side with buy side. See the acceleration in price action right there? That's occurring because you have this. All of this sell side delivery. Remember I taught you yesterday. Sell side delivery is expansion or one directional move lower. Buy side delivery is expansion or one-sided upward, or buy side delivery or advancing expansion move higher in price. Just basically it's directionally driven and it's offering buy side. It's offering it to the market. What do I mean by offering it? Well, if the market does want to gravitate to an old high or relatively equal highs, why is it going there? The algorithm's repricing to that level to offer the buy side. To who? The smart money. That's the way the system works. There is some kind of artificial intelligence that's running things, and it runs very efficient, but it's going to these buy stops in order to offer buy side to smart money. And they will what? They will offset distribute their long positions to willing buyers at a higher price. Where did they buy? Here, there, 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 there. This is institutional order flow entry drill. This is for your notes too. Whenever you're in a buy program, what's a buy program? A buy program is where price is going to be one-sided. It's in the process of running to buy side liquidity or a obvious premium inefficiency, which would be this, okay, or the stops resting above here. Once we cross equilibrium, and now we enter into what? It's a premium market. But at equilibrium, while we're in a buy program or when we're bullish, it acts as a discount. When you are trading in a range, equilibrium, when bullish, is a discount. Equilibrium, when bearish, is a premium. So I mentioned yesterday, we were looking at this fair value gap. I mentioned how we could drop down a little bit. It stayed within the context of that daily fair value gap. Then we started moving higher, higher, New day opening gap. Equilibrium is this level right here. We have a down close candle. Close proximity to that, that means yes, this can be an order block to be traded to. You do not look at these down close candles as an order block. It's not. They are not a bullish order block. ICT, why don't you look at that down close candle or those series of down close candles, and why didn't you look at that as a potential for the trade down to and create as a order block? I just taught it to you. It's relative to the dealing range you're trading in. What's the dealing range? The high and the low. Why is that a dealing range? Because I taught you on April 8th of 2024's live stream that a dealing range is when both sides of the liquidity is taken. What's above this high here? Buy stops. It went above it and then traded lower. Where did this low go to? Just below that low right there. So what did it do? It took both sides of the liquidity. Do you see how the rules keep repeating? Nothing's being reinvented. I'm not manipulating and distorting anything. It's always remaining constant. But you don't want to be looking at down close candles that are in a premium level above equilibrium. This order block returned back to the equilibrium level, or 50% mark of the high and the low, that dealing range. So when it trades above it, yes, we are looking for that to support price. But now watch what takes place. Any down close candle after that, we don't care about referring to it as an order block because we're now in a premium. We don't want to add anything. Remember I was teaching you yesterday? If I'm pyramiding a position, I'm building it into a larger position. Once I get to a point where I have basically 60% of the position, or not position, but the potential unrealized range or target for the trade I'm trying to be a participant in, I stop adding. The hard line rule is once we get into a premium level at equilibrium or higher, I don't want to add anymore. For my own personal tastes, I do it just below equilibrium and I'll stop adding. But the hard line rules are you can do it at equilibrium. But once we go above, if we have any situation like this, don't look at any down close candles once we're in a premium. In a buy program where the market is predisposed to go higher to take out any inefficiency, that's a premium level. This is premium because it's above equilibrium. So if you look at this is the high and this is the low. This inefficiency is where? It's in a discount. It's below the 50%. So that's not a target. So what is it? What is that right there? What is this right here? It's a sell side imbalance, buy side inefficiency. Yes. Basically, it's a down close candle that represents a fair value gap. We are not looking at that as let's get up into that and sell off to take out the relative equal lows down here. So if this SIBI, which is a fair value gap, sell side imbalance, buy side inefficiency, if it's part of the sell side of the curve, this right here, once we cross over there, this becomes an inversion fair value gap. Light bulb moment, right? Oh my goodness, it's starting to make sense. See how the down close candle goes right into the old inefficiency. Everything part of a market maker buy model, because that's what this is, has to match up with the sell side of the curve. Sell side of the curve is when a market maker buy model, it's the initial down run. And then the market claws its way back up to clear out the original consolidation and go above it where the buy stops are going to be resting. So you use all these things like a rock climber does. When you're looking at this rock surface or this cliff of price action from this high down to that low, my mind is, okay, we're going to need to use this. We're going to need to use that. We're going to need to use that. And the zenith, to get to the top of it is here. That's my goal. But all of these price points here are footholds. I'm going to wait once I get to these areas where I can grab on to something that gets me into this vicinity where I can place my foot under that. Then I'm going to wait for a new handhold, a little area where I can put my hand on it and then pull myself up to get into this area. So these are all known. They're static. They can't hide them from you. So when you know that, you can take the very casual approach to seeing, oh, well, this is This is where I want to focus. And when price does in fact get above it, like a rock climber, they're going to want to use it as a foothold. And they climb up above it. Another foothold. Climb up into this area here. Foothold. Same thing here. This is not support and resistance, folks. This is all coded. It's all algorithmically designed. This run here, look how it completely shoots up and re-delivers all of the sell side delivery here, all these expansive candles that are down closed. That thin price action, real quick sudden movement lower, it's replicated with the movement up. What does that tell you? That's a signature that you're absolutely going to see the buy side get hit. That's designed to be there. But this quick delivery and price action, that matches the quick delivery price action on the downside. So when I'm talking about I want to see certain signatures in price action, that's a signature. Just like I want to see when price starts to rally, every down close candle that offers a fair value gap, if you're in a buy program, you are not thinking, oh, I'm going to go up here and sell short into that, or I'm going to go and sell short into that, or it's going to go up here and then I'm going to sell short into that. You see how you have to have an understanding of the higher time frame. You have to flesh out a narrative why price should behave a certain way. So you can see how once we got through it, both fast movement lower, fast movement higher, down. Look at the bodies respecting what? What is it respecting? The inefficiency. There's no support resistance there. It's the fact that that inefficiency is being referred to by the algorithm. So now it will do what? It will then run from there to go to the buy side right there. And that's what you see. Then you have relative equal highs, which they'll leave in place so that way people will trust what? They'll think it's resistance. So if anybody sees that as resistance, retail is going to want to do with that. They're going to want to go short. They drop it down. Where does it drop to? What's this level? That's equilibrium. So the market comes all the way back down into equilibrium, rallies, and then we blow out the highs.